Hello, everyone, and welcome to another episode of the None of Our Businesses show and podcast. We are doing another roundtable session from our home offices, bedrooms, wherever we happen to be at the moment. And with me, as always, is Charlie Zigman and AJ Wheeler. Hey, guys.
How's it going?
Hey, thanks.
Happy Friday.
So we got some current events to go through, as always, from an accountant's perspective, current business events from an accountant's perspective. Let's do this.
All right, so if we can start off, I've got an article from Accounting Today called 5 Steps to Keep Business Development Alive in the Pandemic. And so basically this author is trying to give an idea, it's written towards CPA firms, and it's trying to give an idea of how to keep sales going throughout this trying time. And his take on it is to break it down into 5 steps that you can do. His steps are to dig into old pipelines. So go back and talk to clients that you maybe talked to 6 months to a year ago. To reframe what business development means. So if you used to go to networking events that were in person, he believes you should do virtual networking. Take value virtual, which can mean a lot of things, but basically to try to make your sales pitch in a digital way. And then monetize and capitalize on content. And then finally, sample your innovations. So that's the idea of maybe changing your billing structure. If you've had something you've always wanted to try during this time, maybe the pandemic is a really good time to give that a try. And so I wanted to kind of get you guys' take on whether these sound reasonable to you, and if maybe there are a few more things that belong in the list that the author didn't mention.
I think it matches what we've discussed internally on this podcast publicly, where, and Ty said it before, never waste a good crisis to reevaluate everything. And I think that's definitely true with, reevaluating your business, but even more so in how you're developing clients. Because I think beyond anything, this pandemic's probably shift how we interact with each other more. And I think, we've talked about it on the podcast, I think remote work and this Zoom kind of meeting thing is here to stay even after we lift all the restrictions. And so, kind of the last few months have been, getting your feet underneath you and getting moving forward. But I definitely think that business development needs to be on everybody's mind going forward, because you're going to have a new normal here pretty soon that we're going to come out the other side from this. And how then do you, kind of shift streams to match that new normal? I think one of the big things is what we're doing on this podcast is pumping out a lot of content around things that we feel strongly about and talking about those issues openly and open for discussion. And I mean, we'd love comments coming back and having a back and forth discussion with our viewers on these things, as well as each other. I mean, we lean on each other a lot to kind of think about these things through. And I guess I feel really fortunate to be in a company and with friends that we can kind of, and coworkers that we can bounce these ideas off of. And we're a very agile firm to be able to make those changes to switch to a digital marketing strategy or remote work, or be able to quickly change stream and, change up services that we're offering and pivoting and steering more into one side of the business than the other, because that's what's available at the time and what seems to be the demand from customers at the time. Also, coupled with that, then changing how our sales pipeline comes in. Where are we receiving our new clients from? And then expanding upon that and doubling down on the places that we're getting good referrals from, and we're getting a good sales pipeline for customers we can help, and we can, steer in the right direction that way. So I think the article's spot on, and it kind of is, confirms what we've all been talking about for the longest time. So I guess it's kind of good, to hear it from an outside source that I think we're kind of thinking the right way if we agree with the article.
Yeah, and I think what I appreciate about the article is just kind of the listing of some of those things you listed, Charlie. It's somewhat confirmatory because, what AJ was talking about, kind of the concept of working our network and trying to work that digitally. Our firm does CFO advisory services and outsourced accounting, which is kind of the non-traditional services for CPA and accounting firms. And so what we've been doing a lot in the last 10 months is working a lot with our network and our colleagues that are other accountants and CPAs who maybe do more of the traditional services, and letting them know what we do. And we've found that's like our best lead source, because other accountants understand better what we do more than anyone else. They know what they do, and they know kind of how we might fit into that in terms of what we do. So, other tax preparers, for example, who know, well, TCA doesn't prepare taxes, but they do outsourced accounting to help clean up some books before the taxes get prepared. Or if you have a client that is looking to go out for a loan, or is looking to get an audit or something else and needs to get their books cleaned up before that, those are the kinds of services that we do in the outsourced accounting, on top of kind of the CFO advisory piece, which is the cash flow planning and forecasting, which a lot of traditional accounting firms don't do those kind of services. And so when this coronavirus crisis hit, we were kind of starting to hit our stride, being a relatively new business. We're only a few years old here, because we kind of I came out of being a partner in a regular public accounting firm, came out of that, and then started this practice and was already trying to do something a little bit different with it, right? And you guys came along and joined me. And so here we were doing this, and pre-coronavirus, we were starting to hit our stride with kind of this one-on-one kind of networking, whether it was going to coffee or going to lunches or doing continuing education events or whatever. And then coronavirus hits, and everybody has to stay at home, and we can't do those things anymore. And so for me, like, the thing that made sense to jump to do right away was, well, if we can't go to coffee and we can't go to lunch, let's reach out to our network, and let's just start having Zoom call sessions with the same, this group of people that we network with. Let's keep in touch with them. Let's make sure we know how they're doing, and kind of exchange information about what we hear about things going on in business and what they hear, and all of that. Let's keep that up. And so that's what I've been doing. But I've had this sinking feeling in my head of, well, is that right? Am I just taking kind of an analog methodology and pushing it into a digital world and totally missing the boat? So yeah, I think, having looked at that article and in kind of what you were saying, it sounds like they're kind of advising to do something similar to what we're doing on here. So that's good to hear.
Yeah, totally. I think it is. And it's like, it's easy to feel down because the pandemic happened, and it's hard to keep sales going during the pandemic, but you really got to think and realize, well, that's happening to everybody else too. So we're on a level playing field, and now it's a question of just how to adapt to that. And like you said, I think that doing these virtual things is really just the best way to make use of the technology that we have. And so, yeah. You got another article we can talk about, AJ?
Yeah, this one's actually for Charlie because it's an Amazon article. So,
all right, let's do it.
This one's entitled "The Rule." This is from Yahoo Finance. The rule that made Jeff Bezos the richest person in the world. So this article is referring to what is often called the two pizza rule. That was, I guess it wasn't invented by Amazon, but they called it the two pizza rule. So it's Amazon's two pizza rule now. So they get the claim that it's theirs. But the idea behind it is, and I kind of looked, the article is very small, but I looked into what the article is based on, which is actually an article or an ebook called The Amazon Machine by Benedict Evans. And he goes on to explain he was at Amazon when it took off. And so he really digs into what this two pizza rule is. In 2002, they instituted the rule where all working teams in the company had to be small enough to be fed with just two pizzas. So in that case, and the theory is that if you keep the team small enough, there's not this wasted time of focus groups and unnecessary meetings and meeting in a central location. It's a very small, dedicated team. And so I wanted to look at what they were building those teams for. And so what they were building those teams for were the launch of new product segments or commodities. And at Amazon, they don't look at individual products like GE Lightbulbs, which we'll talk about later, or cleaning products, household cleaning products. Do we have Clorox and all these other wipes that you have? It's the whole segment. So household goods or menswear in different areas, Germany, US, or whatever. And so when they were reaching when they were launching these new categories that they consider commodities, not the individual products themselves, they would devise a team, a very small team of about 4 or 5 people, often without experience in e-market, in e-commerce, or even the segment of the commodity that they were launching. And they were basically given a budget and an autonomy, and the only reporting that went directly to a very high up, basically Jeff Bezos and this guy, to review the progress and what they were doing in real time through these e-sheets that happened. And this is as far back as 2002. So I guess the reason why I bring it up is, do you guys think that this would work in like an accounting firm or in regular business? Or is this kind of one of those things that's, more for a commodity dealer, I guess, like Amazon? Do you think that small team, small input, output kind of a targeted team works in a different environment other than?
Yeah, I mean, I think it definitely works in a wide variety of businesses. I think it sounds to me, or it strikes me as the perfect juxtaposition to this kind of culture we have in business today of ultimate collaboration, right? I mean, there's this culture in corporate America of, oh, you got to collaborate, you got to get everybody, on the page. In some cases, we got to get the whole company together, and we got to all collaborate on this or that. And I just, maybe controversial for me to say, but I just kind of reject that thinking altogether, because I think collaboration has its place. There's a certain amount of collaboration when it comes to doing some research and discussion and making sure that you're open to different ideas. But when you're actually trying to get something done, my dad always had this saying that a camel is a horse put together by a committee. And so the thought, there is that and I was just watching another YouTube show and podcast. Maybe I'll find the name of that and shoot it to our producer Ethan to put in the links here. But they were interviewing a guy named Parker, who was the founder of the company Zenefits. And he said this too. He was talking about when they kind of roll out something new, that having it in one person's head and working through it is a lot more efficient than kind of trying to do it by some big committee. So, I mean, I think, in a company like Amazon, you're doing a new, it sounds like it's kind of it's an attempt to split the difference on these two frames of thought, right? I mean, they're not bringing it down to just saying, hey, one dude, here you go, you come up with a new product and it's all on you. They still have a team, but they're trying to scale it down to what they found to be an effective size team that doesn't have collaboration bloat, and that makes total sense to me.
Yeah, what they said was the quote from the article was decentralized distribution of invention throughout the company, not only the leaders, is the only way to get a high, robust throughput innovation. And so the idea is, we're going to split it up to smaller teams that can make the decisions autonomously. He had even acknowledged in there that he said that we know that doing this leads to a lot of flops, because when you have small teams, a lot of times they go down the wrong path and they make something that wasn't a win. But his response to that was that while failure comes with invention, it's not optional, and you're just trading off the weaknesses of the approach with the need to innovate. And so I think it's a good rule. I think it applies to a lot of different companies, and I can say that I've personally worked in a company where having so many people involved in a single decision can lead it to a complete stop, because everyone has an opinion and you just get too many people who can't agree. And so I think it's good at stopping that problem.
I think for me, it kind of, and to Ty's point, it kind of strikes that right balance between oversaturation and like homization of ideas in a corporate setting where there's like focus groups and you're trying to please everybody that's involved in the process. You're kind of whittling that down to enough people where hopefully the good ideas pop out. But then it's not just one person driving, it's not just one person driving it from beginning to end, and there's some kind of oversight on the process. And so I think it does strike the right balance between that. because definitely been in situations, and I think I take that back. I think it depends on the type of work that's being done as well. Often when we're working, like if you're talking about a public accounting firm, for instance, and you're talking about an audit team, the reason a team is needed for an audit isn't because, it's not that a partner and one staff person couldn't do the work. It's the amount of work required within a specific time frame that builds out the necessity to have team members do it, a division of labor to make sure that the items. But again, you're not talking about a new process or a new product or anything like that. You're talking about doing the same work over and over again. So I think when you're talking about a new segment or a new idea or a new kind of product line or a pivot, you probably need more people involved with that just for the idea collaboration and to smooth out any rough spots that somebody might have blinders on if they're just speeding full speed toward an answer that they think they've glommed onto.
Yeah, totally. And the other thing that I've seen that I think is in line with this principle, but wasn't in the article, is I've heard the saying that they were going to do meetings, but you're going to talk with your feet. And so basically, if you don't feel that you belong in this meeting, you should get up and leave and go do what you feel is useful to you. And that's a similar way of like, let's cut the bloat down to where it's just the people who actually care about the topic, So yeah.
And I'm sure we can all agree that like too many meetings, I mean, the same problem comes up over and over and over again when it should have been addressed the first time that we had the meeting to discuss the problem. And so too many voices in it, I think, drag it down to a point where nothing gets accomplished and they're just meeting to meet.
I agree.
So perhaps instead of walking away during these times, it's turning your screen off in the Zoom session.
Yeah, if you
going to the blank screen, turning the video off.
You got nothing to say, just mute your mic and
right. Just mute your mic.
Yeah.
Stop video, let that default picture come up and listen or continue to work on something else.
Or at least put some of those like goggles with fake eyes on and just, look like you're present.
Right. Yeah. All right. The next one I got is from the latest guidance on the PPP loan forgiveness. So I think we talk about this every week. New developments in the SBA PPP loan and loan forgiveness. So this is the latest, I guess, the SBA issued May 23rd, supposedly clarification on the forgiveness process. And so it probably opened more questions than it answered. So the first thing it tried to say was the SBA will review all of the information on the application that includes eligibility, although people below 2 million will not get examined as to whether or not they self-certified as needing the loan at that time. But they will look at the loan amounts and the use of proceeds, loan forgiveness amounts. They're going to dig into what those payroll amounts are. And so they'll start there, and they're going to review the applications regardless of size at any time before the forgiveness is done. And they may require to maintain records, or they're going to require you to maintain records for 6 years afterwards. It's forgiven or paid in full. And so the questions I think that are unanswered for that at this point are unanswered are types of payroll, especially for nonprofits that are uncovered or not, or separately covered, and has been seen as double dipping. For instance, if you have a federal grant that covers wages, they haven't made any kind of clarification on that. The general consensus is that those are not forgivable portions of payroll, but they haven't really struck a clear definition of that. So everybody's going along with those wages are exempt from the calculation of what will be forgiven. The other thing that's unclear right now, because it's still up in the air and we have some information on that, is the bill that just passed on yesterday or Friday, May 28th or 9th, that went through the House, that kind of goes into expanding the time that you have to use the loan, and then also like the amount, the 75-25 rule of 75% has to be towards payroll and 25% has to be for other things. And so that recently got passed by the House, and they're wondering if but it hasn't passed the Senate or been signed into signed by the president. But what it does is the highlights of that now going through would expand the covered period from 8 weeks to 24 weeks, extend the PPP through 12/31/20, expand the maturity from 2 to 5 years of the loan. And then there's a couple other ones. We'll revise the 75/25 to a 60/40 rule, 60% payroll, 40% interest, rent, utilities as such, non-payrolls. And then a deferral of principal, interest, and fees until the date the lender receives payment for forgiven amount of loans, or 10 months after the end of the covered period. So who knows? It's a wait and see, but I thought I'd give you guys a chance to kind of dig in and get your perspective on the new rules.
Well, I think it's I think the statement that comes to mind is it's not over till it's over kind of thing, because like what you just brought up, and yeah, great summary, AJ. And just for our audience, I want to timestamp this. We're talking about this as of May 29th. And so, things on the PPP have been changing sometimes on a daily basis. And to that point, the SBA had already issued kind of an application, what the application might look like, or what the basic application data would look like for forgiveness. And now, as AJ just reported, Congress is debating whether we even are going to apply the 75/25% rule, which has been in the regulations from the beginning of this whole thing. So that brings us to this whole point that it's not over till it's over. And I know a lot of businesses are trying to. I think you've got like three categories of folks. You've got certain folks, and I see the same thing in tax practice from having been a tax consultant, a corporate tax consultant, that when there's new tax law and it's being debated in Congress, a lot of times you have clients and companies that want to discuss it and have advice on what the rules are before the rules are actually settled. And usually in those cases, we just have to say, as professionals, the rules aren't settled yet. If you really want to spend time and money on doing what ifs and talking about here's what might happen if it goes this way and here's what might happen if it goes that way, we can do that. But a lot of times in my experience, when I talk about categories of people asking these questions, you've got some businesses and entrepreneurs who are just anxious. They just want to know. And I think identifying kind of why you want to know and what's important here is good, because I can understand the angst and just wanting to know. But the truth is, we don't know. It's not over till it's over. And you're not really going to know for sure because of the way they've been playing this PPP game. I don't think we really know for sure until the applications are hitting the banks, because, up until that point, it's still, you're still going to have the Treasury saying things, and you're going to have politics being played, and you just never know what new thing can come out. And not for nothing, even after the applications hit the banks, there could be a reversal of something, right? But at least you're kind of closer to more of a determinative point when that happens, when your bank actually is accepting an application for forgiveness and you're having to do the calculation at that point. That's kind of when well, here's all the rules that have been stated so far. That's what we have to go with, right? But if you're not there yet, you're not even ready to submit, then if you're just anxious you just want to know, you're just going to have to chill out and sit back and say, hey, we don't know for sure. I think there's a second category where it's more than that they just that they want to know. They actually got the funds and then they said, oh shit, if we can't get all of this forgiven, we're not going to spend it. Or we're only going to spend the amount that we get forgiven, and any other amount, we're afraid that we wouldn't be able to fund the payback later, because whatever is not forgiven becomes a loan, right? And so there is a payment period there. I don't know if either of you guys remember what that is. I don't remember that off the top of my head, but the part that's not forgiven.
Yeah, the baseline that they came out with was it's a 1% interest loan and payable back at 2 years. And I can't remember if the 2 years is at the end of the 8-week period or if it's at the beginning, it starts at the beginning of the loan. But I think, if my memory serves me right, it's at the end of that 8-week period.
That sounds right.
And one thing we have to also remember about these loans is that they didn't require personal guarantees. So if your business got the loan and then, if what you're thinking is, oh, I may get this money and then I may still not survive as a business. I may go out of business, and then what? Well, and then presumably you walk away because you didn't provide a personal guarantee for the loan, right? So, I mean, I think there's the second camp that's kind of, they're like worried that, well, whatever I didn't get forgiven, I have to pay back. And, oh, what do I do with myself if I have to pay money back? But I think, that's probably, the fact that you actually have a period of time to pay it back, it's like, well, if you need that money, you still need it, right? Whether it gets forgiven or not, you still needed that money to get over this hump. And if you need it, then you use it. And then you're using it in the hopes of your business survives and then generates future cash flow to pay the loan back, right? So from that standpoint, I would again say to that group of people, I can understand the angst of wanting to know how much is forgiven for because maybe you're going to try to avoid spending it. But I also think there's a little bit of misguided thinking there, in the sense that you probably just have to spend it anyway. There probably isn't as much of a decision to make as you think there is. But then you got the third camp, which maybe doesn't literally need the money. They got the money. They could just, have it in the bank, and they actually don't want to spend any of it unless it's forgiven. And so what they're really doing is they're really trying to figure out what the game is, right? They're playing the game. That third camp's playing the game, and they're wanting to know every possible corner case of, can I pay this or can I pay that, and will that become forgivable under the PPP? Because if it is, then I'm gonna shove it into my 8 weeks of expenses right now, so I get something else that gets forgiven, right? And that's probably a pretty big camp. And so, sure, like if you're trying to play the game, you want to know the rules of the game. But I think that's kind of the nature of what the federal government's done to us here, is they're not letting us play the game because they're not telling us the rules. There's not a game to play because you don't exactly know the rules. So I would advise, hey, forget the game, just spend what you need to spend to survive, which was the intent of this to begin with.
I think you missed a camp, Ty. The fourth camp would be all those good-hearted CPAs that put together the forgiveness worksheet and then gave it out for free, and now have to go back and adjust that and
That's
day
right.
by day to match the upcoming. Yeah,
that's right. The rules as of today. Yeah.
so,
Yeah. That's on that point. We often get asked by our colleagues of saying, oh, well, you do non-traditional services, why, your CFO advisory services, would you do PPP consulting? And we do consult about the PPP with our existing clients, but we're not taking on clients just to do PPP consulting, because what are we going to tell them? We're going to tell them the same thing we're telling everybody on this show right now, that the rules are not set. You don't know what the rules of the game necessarily are. And by the time we get to the point where there is definite more clarity and people are submitting applications, that time period is going to be very small. It's going to be like, okay, now within a few days, everybody's submitting applications. We're not chasing clients to just serve them for like 3 days out of the year. So I think that's that's the issue with that, is that, yeah, I mean, we are helping our existing clients with PPP, but we're not out there trying to find clients just to do PPP consulting for them, because it's too short of a time period, too limited of a scope of service, and we can't really do just that for somebody right this minute anyway.
I'm going to make a bold prediction here. I'm going to say that all of those LinkedIn and kind of marketable CPA, those ones that usually pander towards expanding your client list or making more per engagement, I'm making a prediction that they're going to switch gears here in a second and will go after one-time clients and start advertising for this service at a good amount of money probably when this comes up.
Well, for sure. And I think the piece that I'm being cavalier about is, maybe you do a one-time service for a client, you do really well, and so then you pick them up as a client for life, right? So just because you get engaged for that one limited service doesn't mean that that's all and that, I had a colleague that happened with her. She runs a tax practice a little bit out of town here, out of the metro area of Portland, Oregon here. And she had that exact thing happen, where she provided better advice for free to a small business on how to handle their PPP than their existing accounting firm was providing them. And so once they got through that, they went to her and they said, hey, you did this for us for free. here's how much we pay for our tax work every year. We're bringing it to you. And so those things do happen. So I think you're right, AJ. It could be a good lead thing for some businesses.
Well, and totally, and just putting myself in the perspective of the people who are buying that advice and then buying into it more, I would think that working with that short timeline and constantly changing rules, but then being able to give a good answer would, instill a lot of confidence in that client going forward. So it'd be kind of a very special, way to engage. Yeah.
So I might add that practitioners that are thinking about that probably need to do a longer think on it as you're kind of branding yourself as a last minute can get in there and do it on the turn of a dime kind of person with this PPP because it's so short. Do you now want that to be kind of your identity or brand, that you're somebody that can come in there immediately and fix something? So, I mean, it's something to think about for the practitioners out there that are considering that type of work that we're not. But if you are considering it, consider the effect it would have on your brand, I think would be another point to make.
Yeah, that's very true, because I could totally see you getting set up as, getting that image and then having everybody think that everything has to be solved immediately, even when it's brand new, because you did it that one time, So, all right. So I've got another article, if we can switch gears a little bit. I've got an article in CNN where, let's see, GE is saying goodbye to its 129-year-old light bulb business. And so what's happened is that GE has gone through a bunch of changes recently because they have mountains of debt and they're trying to restructure their business to focus around their kind of four major areas, which are, it was healthcare, it was infrastructure, it was, I'm blanking on what the other two were. Aviation, and then there was one more. But anyway, so they couldn't find a buyer for this light bulb, the light bulb part of their company for years. And so finally they've gotten this smart home company called Savant, who believes that they will be a better fit for that product. And so they're going to buy the GE light bulbs, and then they're going to use them to sell alongside their other smart home solutions. And the thing that I found interesting about this deal is, one, the thing of like businesses pivoting to tricky situations by changing what they do was interesting. But the other thing was that what they're going to do is they're going to have a long-term licensing agreement where this new company, Savant, will be able to still sell the bulbs, but they will be GE branded so that they can capture that brand loyalty. And so I thought it was a little bit interesting because it just kind of shows you how misguided brand loyalty can be if people are buying these light bulbs on the basis, because of the GE name, and the reality is they're just no longer GE bulbs. I'm sure that comes with some level of kind of quality control or something to it, but I just think it's kind of an interesting topic for discussion on is brand loyalty misguided, and are these long-term licensing agreements disingenuous in any way if the only reason people buy this stuff is because of the name, and the name means nothing?
Well, I kind of looked at it from a different angle. I was thinking of, the light bulb was basically the iPad of the, when it came out, or whatever time frame that is. And it's so funny to me now, it's such like a commodity kind of item, where that was like high tech and very specialized, and only the elite had electric light bulbs in their house or electricity in their house. And to see it come full circle now where GE, when I think GE, I don't think of healthcare or GE finance or, the aviation portion. I think of light bulbs, Thomas Edison. But, for them to sell off that part of their business kind of shows how far and what GE has become from like an innovator to a very commoditized, older, life cycle of the business, that now the thing that basically propelled them and was an emerging technology at one time is now being sold off. Basically, everybody can make a light bulb now. And if you go to Home Depot or, the supermarket, you see nobody, at least in my circle or of anybody that I've met, it's not GE or bust. It's like, what can I buy at a decent price that fits my needs? And so the fact that I guess somebody is willing to buy this segment from GE for what should be a substantial amount of money just to come with the little GE symbol on the light bulb is kind of strange to me, because I don't know necessarily that the marketplace is demanding that kind of name brand, and it's viewed more now as a commodity.
Yeah, I think I had the same feeling, AJ, when I think about when I buy light bulbs. I'm not a brand name shopper when it comes to light bulbs per se. But I guess maybe I am in a different way. Like I tend to trust the store that I buy it from. And I do that with a lot of varieties of like commodity goods. Is that the brand that I put my faith in is the retail outlet or the distributor. I kind of think, well, whatever, if it's in this store, then the product selection must be good. Their purchasers have vetted it, so it must be fine. But otherwise, I don't choose a brand name over a generic on a store shelf, generally speaking, for my shopping. But I think that you and I, AJ, are atypical in that point, because that comes back to kind of Charlie's kind of question, which is almost a question about human nature in terms of, isn't it kind of silly that people buy things just because of the brand name on it? And being somebody who doesn't shop brand names, I totally think it's silly. But on the flip side, I also think human nature en masse, that is what we do as human beings. We do buy things based on their brand names, and that brand is, as Gary Vaynerchuk says, brand is everything in terms of the future of business. That it's really about owning brands. So, I don't know the business of owning brands well, but I suspect that business includes a lot of kind of what Charlie indicated may be the case, a lot of agreements and quality control measures to protect the brand that you're licensing, right? If your business becomes, I own a brand, and then I license it out at like a stamp of approval to various operators and manufacturers, then it's really like how you control the that brand image, because that's your asset, becomes really important. And I'm sure they've got procedures and legalities and things set up for exactly for that purpose as they go forward with that.
I'm wondering if this is, oh, sorry, Charlie. I'm wondering if this is generational, because I'm remembering back my father, who would have been 80 this year, he was a big tool guy. He was a mechanic, and he always bought Craftsman from Sears because Craftsman had a lifetime warranty on their tools. And then fast forward to now, our generation, tools are very much commoditized, and Craftsman doesn't hold that same kind of name brand power, because what Craftsman did was they kind of moved themselves from this elite brand of, free replacement guaranteed for life, to a very kind of substandard brand when they kind of got rolled into Kmart. And that brand, now Kmart went away, and now that brand is kind of the lower end of the market. So it doesn't hold the same brand recognition that it did. And I think the GE light bulb could go the same way. If they're not putting their stamp of approval on something that somebody has strong brand loyalty for, it'll die out with the generation that recognizes that brand. And so that's a very possible outcome of this.
Yeah, that makes sense. And then the other thing that I was thinking about is just that how it just goes to show you that brand loyalty exists even in areas that you think that it wouldn't, or just how powerful it is. Because it's like with tools, I kind of get that. I kind of could see how somebody would have, that seems to me like something where brand loyalty would mean a lot, because you use those tools for years, and in a lot of cases you kind of rely on them for your safety, if they're depending on what kind of tool they are. And so like with a light bulb, you don't think of it that way, but I guess even that is, like you said, managed by brand loyalty, and that seal of approval really means a lot to some people. So yeah, just kind of an interesting thing to talk about.
All right. This next article we got is for those tax nerds out there. Ty, you're included in that. Anyway, this is from Accountancy Age, from Accounting Today, sorry. And the title of the article is kind of misleading. It's which IRS division is conducting your R&D credit exam? The answer is crucial. Now, the article really goes into the history of the R&D credit and who examines it and what they do and how that is. What I found interesting, where I guess, and I didn't know this, and so for our viewers that don't, there's 4 principal examination divisions, audit divisions within the IRS. And they're the wage and investment, and that's responsible for personal tax returns. So if you get your personal tax return audited, that's who does it. There's another one, tax exempt and government entities, which is responsible for auditing tax exempt and government entities. Then there's large business international and small business and self-employed. So if you have a business and you're claiming the research function, the last two, the large business and international, LBI, and small business and self-employed are the ones that would be auditing you. The article goes into depth about what those are, or how those limits are done, and kind of the history behind each of them. We won't go into it because I don't think it's that much. The thing to know is if you have assets greater than 10 million, you're large business and international, and anything below that is considered small business or self-employed. I think the real crux of the article, and the reason why I picked it, is the last paragraph in the article where he summarizes. And I'll quote him here. If you filed research credit is selected for audit, the size of your company will likely determine the experience level of your assigned examiner. Regardless of which division your company falls under, your examination will be comprehensive. So be prepared with sound explanations and documentation, and seek advice from a trusted practitioner. And that's Mark Bodenstab. So the reason why I bring it up is I thought maybe I have no idea of what goes into the documentation or calculation of the R&D credit. So I thought maybe Ty could give us an explanation of that, because I know he has a little bit of experience in that field. But also too, if at all you think this is something that a small business could go at it themselves, and is his advice sage in that regard?
Yeah, I mean, I think research credit analysis and documentation, sometimes referred to as research credit studies, is its own little cottage industry these days. So there's entire firms that they specialize in just that, or we see kind of these accounting tax credit firms that maybe specialize in that, along with a few other tax specialties like cost segregation studies or other special tax incentives, and that's all they do. They specialize in that all day long. And I think that if you're claiming really large credits and you're in a complicated industry, or your company is particularly complicated, I think working with specialists like that is probably a good idea in terms of determining your credit, and also mostly the documentation side of it. We do work for our clients where we help them line out their documentation and calculate their credits for their tax preparers. We do that in a very narrow, in a very narrow industry spectrum. We do that with smaller software companies and digital agencies, because we have a lot of knowledge about their operations and how they otherwise operate from our CFO advisory practice, that it lends itself to us understanding kind of the data flow that would be necessary for the research credit analysis and documentation. And so, I mean, and that's the thing, is that most of the work involved there that we're talking about is really the documentation side, because the calculation itself, of course, there's a calculation to do and you want to know what the credit is, and there are some options, but actually there's not that many options in the calculation. So you could literally do all of the options on the same spreadsheet and kind of do scenario analysis of determining what credit you want to go from there usually. So it's not and not only that, but your regular accounting firm who does your tax return, even if they don't specialize in R&D credits or research credits, they've got tax software that can pump through the calculation for you if the raw data is there, right? So it's really the real issue is the documentation of how are you qualifying your research activities? How are you qualifying your qualified research expenditures? How are you calculating those expenditures? And what are your data systems that support those and document those? That's where all the work is. And yeah, I mean, if you're claiming a research credit, you definitely need to do that work. I think if you are a smaller business claiming a very modest credit, you could be trained on how to maintain that documentation, and you could conceivably do it yourself. Although a lot of the client companies that I've worked with, even though I think they probably could do it themselves, have said, "Nah, we don't want to." We want to have that kind of second set of eyes to make sure that what we're documenting would make some sense to somebody else, so that if we ever have to explain it to the IRS, we've at least tried to explain it once to some other accountant too. So I think that's a good exercise.
And that goes along really well with what AJ was saying, that I think is a really good point to consider here, which is that the audit, once you are selected for this, that the audit that they do is comprehensive. And so it's important to kind of think about audit risk when you take your tax positions. And so you might look and say, okay, I feel I know the ins and outs of this credit, but I don't know whether or not I have the documentation well enough to be able to articulate that to someone else. And I don't maybe feel as confident in my other positions, that I would then want to risk those being put to more scrutiny, all because I tried to guess and do this one calculation myself. And so I think it's important to take kind of a holistic approach to your audit risk when taking any position.
Yeah, absolutely. And I think that the more complicated your business is, the larger your credit is, the size of credit doesn't theoretically, like the size of credit itself is not directly related conceptually to how much documentation you should need or not. But in practice, it's an indicator of the complexity of what's going into the overall calculation. In my experience, large credits have more complexity involved. Small credits have less complexity involved. And so if you're trying to claim a fairly large credit, that probably means investing more in your documentation is worthwhile. If you're claiming a smaller credit, it may be easier to, with some advice on the front end, to kind of do some of it yourself.
All right, that makes a lot of sense. So if you guys don't mind, I'll switch gears to another article we can talk about. Got an article from MIT Technology Review entitled "How Companies Plan to Use Technology and Testing to Bring Workers Back." And so it looks at Salesforce as a company and how they've managed to change their rules to try to react to bringing people back from the pandemic to working at the office. And so what they've done is they've said, okay, our 49,000 employees can work from home throughout the rest of the year, and then they can come back. But when they come back to the office, we're going to do some things differently to try to keep everybody safe. And they did some of the things that you would expect. They had temperature, the idea is that they're going to have temperature gauges and thermometers, and they're going to have cameras and sensors and different kinds of technology. One of their more interesting answers to the problem was that they were going to have an app where if you're going to go to work, you tell this app when you're planning on going to work. And what the app does is it thinks about all the other Salesforce employees who are going to go there that day around that time and tries to pick a time so that you don't get bottlenecked in an elevator with all your employees, getting them sick. And so it's just very dystopian, very crazy. And so I kind of wanted to get a feel for what you guys think. Is this too much, or are these good preventative measures that companies can take to try to be safe?
I think, and this is just my opinion, when I was reading this article, or you had posted it, the thought that entered my mind was, yeah, if you have the infrastructure and the free cash flow to start implementing a lot of this stuff, it sounds like a good idea and probably should be. And that's without thinking about personal privacy and micromanagement and all those other things that we've talked about in a previous podcast about people returning to work or working remotely and having those issues crop up. But just from like a health and well-being standpoint, I think, that those make total sense. But my thought goes to those companies that need to stay open, and basically this is another barrier to re-entry into the market, is that if you don't have the funds and the available staff and resources to be able to implement something like this, are people going to then look at your company as not providing safety to the employees? Are you going to be hampered and have to have social distancing and lower numbers inside an office and support an infrastructure that you weren't budgeting for? To have people to even return to some semblance of normal work, I think it puts a real burden on those smaller companies as to how that's going to work. And in lieu of a vaccine or testing that's available for everybody to be able to know if you're coronavirus free, to be able to be in public places, I think is a real hindrance and a barrier to entry for businesses trying to re-enter the market that just isn't thought of right now. And so I guess my heart goes out to those companies that are in that situation.
Oh, definitely. Because one of the things the article talked about was they're going to have these touchless kiosks. And so if you want to really follow suit for Salesforce, you're going to need to get in touch with your touchless kiosk rep to let everybody into the building. And like you said, that's just not happening in small businesses. And so, yeah, it's definitely not a level playing field there. I agree.
Well, and I think that's, I know when you're talking about small businesses, that we're talking about like an office setting specifically here, right? Is that I also know kind of the flip side of it. So many entrepreneurs and small business operators that are like hell bent on getting back into the office, and I think they have to consider these things that you're talking about, and really kind of step back and say, well, is it really worth it? Am I really going to incur the costs of some infrastructure and the hassle of ensuring that the PPE is there and that people are maintaining social distance? For example, here in Portland, Oregon, in the metro area, the way the Oregon rules work, my understanding of them is that, you've got to follow these rules in terms of maintaining social distance between your employees. And you've got to make sure you got to supply them with the appropriate PPE. And then you also have to have somebody who's basically the police officer to ensure everyone's following the rules. At some point you have to ask yourself, well, you may not like the work at home style. You may not have made those investments in the past. And maybe you've been reluctant to even make those investments over the last couple of months, even though you've been kind of forced into it. I know there's some that have still been reluctant to really invest in changing their way of doing things. But I think, there's a real financial penalty here to not changing your ways. So I think I would encourage those kind of holdouts to really consider these alternatives. That, is it really true that you need to get everyone together in the office? And maybe it's not as true as you think it is. Maybe you really should rethink working at home.
Well, and especially when you realize that a lot of that cost is sunk. It's what you're saying, but just to kind of put it in other words, if you're going to spend that money either way on the tech, or you're going to spend it on, the issues that you have from letting people work at home, you're just picking the lesser of two evils at that point. And so sometimes the difference isn't even that, that much. And so it's better to just accept the new reality,
All right. Thanks for watching the podcast. Make sure you click the subscribe, the notification bell, tell your friends, comment if you disagreed with anything we talked about, because there's a lot today. And thanks for watching. We'll see you next week. Bye, everybody.